Every member of parliament thinks they have to raise money through taxes to be able to spend. If you can't get the money, you can't spend it. You can't get it in taxes, you have to borrow it, or you can't spend it. And then you leave the debt to your grandchildren. Okay. The truth is the opposite of that private sector needs the government's money to meet its tax liabilities. So the actual flow is that the government has to spend first before the pounds, the dollars exist, so that taxes can then be paid, so that bonds can then be built. So they've got it all backwards. So once you understand the correct sequence, spending comes first, and then the funds are there for taxes to be paid. The idea of where you get the money is no longer applicable. You start asking different questions.
This is the MMT Podcast with Patricia Pino and Christian Riley. Hi, I'm Christian Riley and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. For as little as $1 a month, you can get early access to all our episodes and patron-only episodes. A big thank you to all our supporters so far. At the beginning there, you heard our guest this week, founder of Modern Monetary Theory, Warren Mosler. And we'll be talking to him in a moment about all things MMT in the current context. There's a fair bit of technical stuff in there, so if this is your first time hearing about MMT, a great introduction is to listen to our episodes 20 and 21 with Warren laying out some basics. One of those basics being that currency issuing governments are the only issuer of the thing they demand in payment of taxes. So in the UK, that thing is called the pound, but this holds true for all other currency issuing governments like, say, the US, Canada, Japan, Australia, or New Zealand. And because the dollars, pounds, or yen to pay taxes can come only from the government that issued them, concerns about these governments running out of their own money are completely unfounded. Also, because currency is issued by a monopolist, the government, ideas about supply and demand that might apply to the price of goods in a competitive market are not applicable to fiat currency. A monopolist is price setter, not price taker, whether the monopolist, in this case the government, knows it or not. And in fact, most governments' preferred economic management tool of choice, monetary policy, is exactly this: controlling money by price, not quantity, adjusting interest rates by a fraction of a percent in the hope that there is a perfect interest rate that will deliver full employment and price stability. Multiple decades of searching haven't revealed this perfect interest rate, but the search gives people with letters after their names a sense of purpose. It keeps them off the streets, and who knows, maybe tomorrow they'll actually find it. Important to note, this is what people mean when they talk about central bank independence. The government give their central bank independence to set interest rates, but that's the limits of the independence. The central bank is the fiscal agent of the government, and in no way does it have a veto over which government checks it's going to clear. So, we start this interview by talking about quantitative easing, and I thought it would be useful to lay out an overview. Learning from Warren and other people we've interviewed, I've found it useful to think of the central bank as a bank. You don't have an account there, but your bank does. And so do all the other commercial banks, and also the central banks of other nations, and also your nation's treasury. There are two types of account at the central bank: a current account and a savings account, also known as checking and savings to our American friends. The savings account is a time deposit account. When you buy a government bond, you give up some of your money for a period of time, anywhere from 3 months to 30 years, and at the end of that period, you get your money back plus interest, and interest payments in the interim. All of these payments are, of course, no problem for a currency issuing government to make. They can't involuntarily default on any payments they've promised to make in their own currency because they issue the currency. So why do governments that issue their own currency sell bonds? Well, it's not to get the money to be able to spend. It's to control interest rates, which is what the central bank has been mandated to do. For a quick explanation of how bond sales maintain interest rates, you can listen to the beginning of our episode 50, which I've linked to in the show notes. And for a deeper explanation, you can listen to our episodes 13, 30, 31, and 43 in that order. Now, regarding government bonds, just to confuse us all, they've all got different names. The US government have called their bonds Treasury securities. Here in the UK, we call them gilts. Thankfully, Japan have helped us all out by calling their government bonds Japanese government bonds, or JGBs. But these are all essentially the same thing. Time deposit accounts at the nation's central bank. So, just sticking with the UK, you can think of government bonds as interest-bearing pounds. And when the government sells a bond, non-interest-bearing pounds are swapped for these interest-bearing pounds at the central bank. And QE is just the reverse of that. The government goes in to buy bonds, and when it does, pounds are moved from the savings account at the Bank of England to current accounts at the Bank of England. Interest-bearing pounds are swapped for non-interest-bearing pounds. Financial pundits like a bit of drama, and so they fall over themselves to characterize QE as printing money, and they warn us that we're all going to be pushing wheelbarrows of cash to the corner shop for a loaf of bread. But monetary operations insiders like Warren see the opposite problem. Because the government is a net payer of interest to the economy, when the government swaps interest-bearing pounds for non-interest-bearing pounds, they're taking away interest income that would have been paid from the government to the economy. And that's why instead of seeing runaway inflation as a result of QE, we see the opposite. We see central banks undershooting their inflation target. As Warren puts it, the government have the gas and the brake pedals confused. Lowering rates brings down inflation, and raising rates, as Warren's MMT white paper puts it, may increase total spending and therefore foster price increases. And we've linked to that white paper in the show notes. Also in the show notes, we've got links to a few other things that came up in the interview. We mentioned Warren's policy proposals to help the US economy recover from the pandemic, so we've linked to those. Warren mentions Chapter 5 of his book for a lengthier explanation of tariffs and imports and exports, and the book, 7 Deadly Innocent Frauds of Economic Policy, is available as a PDF on Warren's site, so we've linked to that. Warren also talks about using coins found in Pompeii as a model for understanding modern money. The full audio of him explaining this is in our episode 28, so we've linked to that. And as ever, we have a link to where you can support our show through Patreon by going to patreon.com/MMTpodcast. Support starts at $1 a month, and you get early access to all our episodes and to patron-only episodes, including ones where you can ask me and Patricia questions. Your financial support really helps keep the show going, and we really appreciate it. Finally, thanks as ever for taking the time to understand MMT and spread the word. I think real change comes from the bottom up, and I think that means it's going to take all of us making as many connections as possible and connecting curious people to the answers they're looking for wherever we can. Of course, if you do happen to be a member of any kind of elite, we like to be inclusive here at the MMT podcast. See what you can do top down. Hopefully we'll all meet in the middle. Let's dive in. Welcome one and all to the MMT podcast. I'm Christian Riley here with my pal Patricia Pino. How are you doing, Patricia?
Yeah, really good. How are you?
I'm very good because we're honoured tonight to be speaking to the father of modern monetary theory.
Very exciting.
Warren Mosler. Hi, Warren. Thanks for joining us.
Good to be here. Good to see you all.
Great.
Yeah, good to see you too.
There's so much to talk about. It's hard to know where to start, but then the Bank of England today just stepped up to the plate and gave us something.
Yeah.
Today's news is the Bank of England, as the BBC puts it, will pump an extra £100 billion into the economy to help fight the downturn. And they say this extra money stimulus, known as quantitative easing.
Yeah.
Now, I think you would take issue with this characterization of quantitative easing. Am I right?
Yeah. Look, the Bank of England is a bank. And in this case, it's like any other bank in the sense that, let's say Barclays made an announcement that it would like to buy back people's time deposit savings accounts and just credit them with checking accounts. And it's going to offer them a small premium, very small premium, 1/100th of 1% to do that. And they would expect to move $100 billion from people's savings accounts to people's checking accounts. Now, would anybody expect that to have any effect on the real economy? No. So the Federal Reserve has money in savings accounts, or the Bank of England has money in savings accounts called gilts or treasury securities. What do you all call them over there?
Gilts.
Gilts, right. Those are just time deposits at the Bank of England. You give them money, they give it back to you later with interest. That's a time deposit at a Bank of England. And they're going to offer to shift those pounds from those securities accounts at the Bank of England, those savings accounts, to checking accounts, to reserves, to overnight deposits at the Bank of England. And those gilts are bought and sold continuously, and they will just come in at normal market prices and offer the going rate, whatever these people would have sold their gilts at anyways. Their price isn't going to change very much, maybe 1/100% or something. And there'll be people selling their gilts in the normal course of business and getting paid for it, having money shifted from their gilt account to their checking account. It's like, so what? It doesn't do anything. Any effect is just a placebo. There's no monetary channel from quantitative easing to anything except psychological. And they keep doing this. And so anyway, I just thought I'd point that out.
Can I ask a question directly related to that? Because the BBC also produced a very nice guide as to why QE will work and solve all our problems. And one of the things...
excuse me, I must be totally wrong, and let's go talk about something else.
Yeah, basically. So what they're saying is that QE will obviously generate more funds to be lent to businesses and individuals. Although they don't explain exactly why, but why do they think that?
I have an answer I use a lot. It's like, well, you must be new here if you're asking that question. They're just going along with this headline rhetoric, and nobody's challenged it since the beginning. I remember I was at a meeting at the Bank of England that Professor Charles Goodhart had actually invited me to back in the late 1990s. And there was somebody there from the Bank of Japan. They had a contingent, and they had just started doing quantitative easing. They were buying JGBs. And I said to one of them, how is that supposed to make any difference? It's not like the banks have a line of people looking to borrow money. If only they had yen to lend, loans create their own deposits. And it's not like they're waiting for them to build balances at the Bank of Japan. And so if you buy their JGBs, you're just debiting their securities accounts and crediting their reserve accounts. How does that affect lending? And there was a gentleman named Crocker, who was at the Bank of England at the time next to me, listening, and he looks over at the gentleman from the Bank of Japan. He goes, "Yeah, what do you have to say to that?" He said, well, that's our policy, and we believe it's going to help the economy or something. He didn't have any real answers because there isn't one. But that was 30 years ago, okay? No, 25 years ago, I'm sorry. The operations people inside these banks, if you go to the senior staff, the head of monetary affairs or whatever they call it at the Bank of England, he knows exactly what I'm saying, and he would completely agree with me. But for whatever reason, the politics are different. The headline presentation is entirely different. So let me add here that the Bank of Japan now, for 30 years since that meeting, has done more QE than anybody could imagine on higher numbers of JGBs. Practically the entire public debt is now in reserves and not in JGBs, in the hands of the public. And they have had no inflation. They're still fighting deflation, right? They haven't had any kind of runaway economy because of low rates, and the currency has been strong the whole time. They haven't had any currency collapse or depreciation or anything like that, for like 30 years. And what did they say a couple of years ago? We just need a little more time. Maybe it was last year. The Bank of Japan was asked about these policies, why these not working. The answer was, we just need a little more time. Before she left, after 5 or 6 years, Janet Yellen was there. We just need a little more time. And Mario Draghi, we just need a little more time. It doesn't work. Okay. And there's no reason in theory to think it would work. And there's no evidence in practice that it does work in the way they have hoped it would work. And it's still out there.
So, regarding how they think it works, there's a little infographic that they've put up on the BBC website, Quantitative Easing as a Theory. And there's 6 steps to it. And I was just going to go through it.
Oh, okay.
And let you jump in where I think you would take issue with how they think it works.
Okay.
So step 1 is central bank creates money.
Yeah. Okay, let me just start right there.
Straight away.
Yes, but only under the very narrow definition of money. They count pounds people hold in one type of account at the Bank of England money, and the other type, for purposes of this explanation, they're not counting as money. I would count them both as money. Whether you have money in a savings account or a checking account, they both, for this purpose of this analysis, would count as money. And if you count both of them, it just shifts money back and forth. It doesn't create it. If you count one of them, sure, it creates money.
Got it. And also, I was thinking, when I see central bank in my mind, I just say government as well, because, it's part of the government. When they say, the government can now be directly funded by the central bank, I read that as the government can now be directly funded by the government.
Yeah, exactly. Perfect.
So central bank creates money. Step 2, to buy bonds from financial institutions. That's step 2, leading to businesses and people to borrow more.
Okay, so it's buying them from financial institutions who would have probably sold them anyway.
Yeah.
Because it doesn't matter if Citibank came and bought bonds, or Barclays came and bought bonds, or the Bank of England came and bought bonds. Nobody really cares who bought the bonds. They're sold by willing sellers who are going to sell them anyway. Nobody is forced to sell something they would rather hold.
Okay.
It's a two-sided agreement, and they're thinking about it as if it was just all one-sided.
Well, but what I'm thinking is, let's say just Barclays came in and said they're going to buy $100 billion worth of bonds. Somebody say, that's going to really help the economy here because they're going to buy some gilts. No, they buy them and sell them every day and nobody cares. When the Bank of England does, they do care. Why? Because they have these narrow definitions of money that are throwbacks to the days of convertible money. Maybe they were on the gold standard at one point. One type of account was convertible into gold and another wasn't. They wanted to keep track of which account the money was. Well, that hasn't been applicable for a long time, right? But that's where it came from, and it's all harkens back to that.
And, I think there's a problem with this statement that central bank buys bonds from financial institutions. That leads businesses and people to borrow more. Does it?
Yeah, again, back to my question to the gentleman from the Bank of Japan. Is there this line of borrowers at the bank waiting for money to come in so they can borrow it? Have you ever gone to a bank and said, well, yes, we've approved your loan, but we have to wait until we get the money? Of course not. There's no such thing. Right?
And then step 3, which reduces interest rates. Well, already it's fallen apart.
Well, they can set interest rates wherever they want.
We know they do, yeah.
Yeah, so if they want to use this as a proxy for setting rates, then the headline should be the Bank of England is working to lower long-term rates to help the market. Now, we know that doesn't help either, but that would at least be consistent with that type of explanation of QE, right?
Yeah. And then this makes people spend more, and that creates jobs, because the interest rates have gone down.
Yeah.
I mean, that's neoclassical as flip, isn't it?
Well, what we have today is with very large public debt. How large is public debt in the UK? Is it 100% of GDP? I don't even know. But with very large numbers, that's the net financial assets in the economy. So those are all people holding all of those gilts, making that whatever interest they pay. And when they lower rates, they're reducing interest payments to the people with money. So how does reducing interest payments to the economy help the economy? It's a cut in government spending.
Yeah.
It's not an increase in government spending. So somehow a cut in spending at the macro level is supposed to cause the economy to do better. And again, there's absolutely no evidence that happens.
Yeah. The final step was, and this boosts the economy. And you just answered that question. So then there's this other idea, because we go, MMT people, post-Keynesian people go, look, QE doesn't do anything while everyone's running around screaming about, the Weimar Republic and Zimbabwe, it doesn't lead to runaway inflation.
No.
Then they come back, but it leads to asset price inflation. QE leads to asset price inflation.
Yeah.
What's your view on that?
So my view on that is the base case for asset prices is with a permanent zero rate policy. So if you had a permanent zero rate policy and Treasury bonds, you either didn't issue them or you issued 3-month bills, but they were at zero, and it was just another form of money, another way to hold your money. But basically, the policy rate was zero. All other rates reflected risk. Then that leads to a given asset price for any asset. And when you raise rates, now you're changing asset prices. Let's say you're depressing the prices of bonds. If the base case is a zero rate, and now you raise rates, all the bonds you issued, anybody issued, not the government, have less value. So what it is raising rates works to reduce asset prices. Lowering rates puts them back to where they would have been if you had never raised rates to begin with. And this is just a static analysis, which doesn't hold true dynamically, but just to start from that point of view, the static analysis. So, and if you look at Japan, who's had zero rates for 30 years, show me the asset price inflation there. It's been relatively stable. Their stock market hit a high of almost 40,000, 39,000 over 30 years ago, and now it's 22,000. So 30 years of zero rates didn't cause the stock market to double and triple and run away any. Housing prices, land prices, all those things peaked way back then, and they're still a fraction of what they were back then. And so, you can't see over long periods of time that you've had any major asset price inflation. Look at Europe. How long have they had zero rates and negative rates? You see any asset price inflation? No, bonds adjusted to the rate because bonds are, an expression of the interest rate. And then you just kind of stay there. Okay, you wind up back at what I would call the base case for analysis. You don't pay interest on your excess spending. And so the policy rate is zero. And then if you want to analyze what happens if you raise rates, fine. You can tell me what will happen to asset prices if you raise rates. And then what happens if you lower them back to the base case? I don't know. Is that making sense?
Kind of. Patricia, did you want to say something?
Well, I was just wondering because obviously in the UK, I think when people say asset price inflation, primarily they're referring to property prices. And I think that it resonates with people because we've seen such a high escalation of property prices in the UK for the last few decades.
So I had an idea on that.
Mm-hmm.
You want to hear my idea about property prices?
Please.
Yeah.
So let's say you took the entire tax collection for the UK and you eliminated every tax, VAT, everything. And instead you just had a property tax and you divided it among the number of properties. And it might be 10% of the value of the property, which would be fairly high by anybody's measure. But you also have full employment and job guarantee in place. So if somebody loses their job, they're not out in the street and they don't lose their home. They can still afford to make their payments, on a modest house. And so it's not like what happened in Europe, like Italy, where they put a property tax on and then cause people to be out of work with no compensation and people get thrown out of their homes. I'm talking about running a socially equitable economy where you're guaranteed a job and everything is paid for by the property tax. Okay. So the one negative of the property tax, which is if you lose your job, you get thrown out of your home, it's taken away. That's the only negative. Okay, so now one of the problems in the UK is non-residents buying properties. And that's been driving up prices, right? Particularly in London. And it's caused the city to be almost vacant in some what were nice neighborhoods. They're like ghost towns because all the owners aren't residents. All right, so once your property tax is 10%, the tax liability for running the whole economy is being borne by the person's home and not by their income and not by sales or anything else, just by your home ownership. So if you're a non-resident and you have a flat in London, you're paying your pro rata share based on the value of your flat to run the entire government, not just the property tax for the city of London, right? And so it's gone up by maybe 5 or 10 times. And if it's 10% and you've got a £5 million flat and you're paying 10%, 500,000 pounds a year just in property tax, it's a very unattractive proposition. If you're a resident and you live there anyway, it's fine because you're not paying income taxes, you're not paying VATs, you're not paying all these other things you pay. But a non-resident doesn't pay those anyway. So the real increase is on the non-resident. And the resident, it's not an increase at all. And because it's a big increase on the non-resident, that keeps the tax on the residents down. So the biggest cause of this property thing is the non-resident investment. I could be wrong. At least one major cause. And then this switching over to a property tax mitigates that dramatically. It also probably increases the real GDP of the country by shifts maybe 15% of it away from tax compliance into what could be some other productive things, such as better public education, more public services, or even lower taxes if you wanted to, because of the compliance costs for VAT. Look at all the record keeping you have to have for that, and all the cheating and all the court cases. Look at all the income taxes and all the corporate income taxes and all these other things that have huge compliance costs. I mean, you look at a bank, they're probably paying billions of pounds for record keeping and accountants for this, which all goes away. And so the true cost to the economy is all those people tied up in this financial sector for record keeping and compliance that are suddenly freed up to do things that could be a lot more useful for the economy. And so it would have an enormous impact on the standard of living. It could increase your standard of living by 10 to 15% and go a long way to eliminating the housing cost problem.
Yeah, that kind of reminds me of what you said about moving to Medicare for all for Americans.
Yeah.
There's a whole sort of, I don't know, what's the word, ancillary stuff that goes on with Medicare for all that just goes away. And now we've got people freed up to do other things. So it's deflationary.
Think about who would get the benefit of these other things. Okay, the people, the highest income people are already eating 3 meals a day. They're not going to eat more. They're not going to travel more. They're already doing all that stuff. Their real consumption is not going to go up. So if you're increasing, real consumption from 15% waste to 15% real stuff, it's going to go largely to the lower 50% of income earners because the others aren't going to change their consumption. So one way or another, either through services or goods, it's going to wind up in the lower income groups. And so that 15% of 50% is a big number. That's like a 30% increase So it's a highly progressive thing to do. It's not a regressive thing to do. So the irony is that eliminating the income tax, which is presumably progressive, because you're eliminating the compliance costs, which are regressive, is one of the more progressive things you can do. Try selling that to somebody, over a beer at a pub. Good luck on that. But it can be shown to be a fact, not any kind of like theory or conjecture.
Yeah, that's some next level salesmanship right there. We're probably not there yet.
Yeah.
But it makes me think about, so we're talking about an asset price inflation, and that's different to consumer price inflation.
Yeah.
And so what's the difference between calling house prices going up and asset price inflation, as opposed to is that not just a market signal?
Yeah, it is. But the thing is, the whole idea of inflation, the way the mainstream defines it, is political.
Right.
It's like, what's the purpose? What's the further purpose? So we know how much to pay our public employees. So we know how much a pensioner should get every year. So we can index our rent payments, right? They all have further purposes. So it's called the Consumer Price Index, because we want to know how much it costs the consumer to live, not because that's some academic or financial definition of inflation. It's all, the whole further purpose is for making payments and compensation and, keeping track of social equity, right? It's got nothing to do with the general price level, right? It's got much more further purpose to it. It's not about right or wrong, it's about what purpose is this whole thing serving. And so that needs to get tailored to however you want to direct public policy rather than not. And so, the academic definition of inflation is very different, right? It's a continuous increase in the price level. And I've given that talk at the UMKC conference a few years ago. And right now, what is the inflation rate? So let's say I ask a central banker, what's the rate of inflation? They'll say, well, last month it was up 0.2%. Prices went up. Okay, but what is it now? You can tell you what it did for the last year. You can say, well, my forecast is for 2% next year. All right, but what is the rate of inflation now? He doesn't even know what you're talking about, right? There is no such thing. So they don't have even a concept of what that is. They might think in the abstract it might be some second derivative of something, but they don't have any way of measuring it. They don't even know exactly what the price level is. They can say, well, core is this, CPI did that, and home prices did this. They can't tell you what the rate of inflation is as academically defined. So what's the answer to that? So the academic definition of inflation is a continuous increase in the price level based by today's agents, today's people, you and I. So what continuous increase in the price level do we face right now? What that means is if I want to buy a bar of gold for delivery today, it's going to cost me £1,000. What about if I want to buy a bar of gold for delivery a year from now, not pay for it a year from now? Let's say I'm a jeweler. How much is that going to cost me right now? All right. Well, if the interest rate is zero and there's no storage costs or anything, it's going to cost you £1,000. That's called the forward price. What you have to pay for this thing if you want to pay for it next year. You don't want it now. I bought my gold for this year, but I want to buy my gold for the next 5 years and get it delivered, every year for the next 5 years. I go through 1,000 ounces of gold. I want a contract for that now. What's the market going to charge me for that? If the 5-year interest rate is zero, it's going to charge you the same all the way out because the people selling it are going to be indifferent between holding it or not holding it because it costs them nothing to hold it because they can borrow money at zero, let's say, just for sake of this discussion. Policy rate zero. And it's the same with the gold miner. If he wants to sell his gold now, it'll lock in his price so he can go out and buy his equipment. He's going to get the same price for gold in 5 years as he would get by selling it today if the interest rate is zero. Now, if the interest rate goes to 10%, to keep the math easy, maths, as you say, mathematics, easy, and I can buy gold for £1,000 this year. If I want to buy gold for delivery a year from now, how much is it going to cost me? Well, it's going to cost me £1,100, right? Because the guy who has to wait a year for his money could have had him in the bank at 10%, right? Because the interest rate's 10%. So he's not going to delay getting the money for a year. And if you pay £1,100 and you don't have to pay for a year, you get to keep your money in the bank at 10%. So you don't care. So the indifference rates for buyers and sellers goes up by 10%. And that would go on all the way out. If there was a 5-year rate, policy rate was 10%, then you'd have the 5-year inflation rate, the term structure of prices faced by you and I, by gold miners, by jewelers, would be 10%. We'd be saying, okay, if I want to buy it for next year, each year I can buy it right now, but it's going to be costing me 10% more, 10% more, 10% more. And so the term structure of prices based by you and I, is going up continuously at 10% if the policy rate is 10%. And so what we could say is the policy rate is the rate of inflation based on the academic definition of inflation. Now, that doesn't mean gold will be more expensive next year. It might be cheaper. It might be twice as much. But it says right now, you're facing a term structure of prices that's continuously increasing at 10%. And if the Bank of England changes the rate from 10 to 0, you will be facing a term structure of prices that's flat. So every time they change rates, they are changing the term structure of prices faced by the entire economy through time. Okay. And that's not theory. That is actual fact, based on that's how money works. It's called the own rate for that particular commodity. You want to get technical. All right. So how many central banks have ever discussed the fact that every, 1 basis point they change in rates is affecting the term structure of rates like that, is affecting the term structure of prices based by the entire economy, is changing the inflation rate precisely in line with their interest rate is the inflation rate as academically defined. How many of them ever even discussed that if you go through the minutes? Like zero in the history of central banking. They just don't do it. Right now, what effect does it have on the economy to change the term structure of prices that you and I have to face making decisions to buy a house or to invest or anything else? We don't know. They spend their whole 200 million pounds of research on something else that doesn't even, like QE, that doesn't even have any connection whatsoever. So all I suggest is they take a look at it and direct some of their hundreds of PhDs in the direction of maybe one or two of them. So take a chance that it may be important information that they ought to know that this policy rate they're setting is the inflation rate and figure out how they're affecting the economy.
Okay, well, that moves us nicely into another section that I wanted to ask you about.
Yeah.
Obviously, before QE and before interest rates got so low, the central bank used to use bond sales as a reserve drain, which is your famous observation.
Yeah.
Bond sales are a reserve drain to target interest rates. I think I'm right in saying,
Yeah.
And we've talked about that in previous podcasts.
Yeah.
And obviously now they don't do that. So a lot of central banks, I know that Bank of England and I'm sure the Fed now offer interest on excess reserves. I think that's what it's called.
Yeah.
Or a support rate is another term I've heard.
Yeah.
And that's how they target their interest rate.
Right.
So that given, and I think I know the answer to this,
okay,
but should there even be a government bond market in your opinion?
No, and there never needed to be. It used to function to, again, way back, even before I was born. The money in reserve accounts was convertible into gold. And so people every day when they had dollars, or pounds, they could switch them into gold at the going rate at the central bank. And they might do that. And so what the central banks would do, or what the governments would do, is offer an alternative, which they called a gilt or a treasury bond, billed notes or bonds. This alternative was competing with the option to convert. And they put them out at auction. You want to keep your gold, or look, we're going to have these treasury securities. You tell us what interest rate you want. Treasury securities, which means you're going to take your dollars and put them in a different account at the Fed, a different account at the Bank of England, where you can't get your gold right away. It's 1 year or 2 years at an interest rate. And that you are willing to give up your option to convert for 1 year, 2 years, or 3 years and hold the interest rate. That's the statement you're making when you're bidding on government bonds. My bid for a 2 year is 3%. Well, that means at 3%, I'd rather have the bond than the gold. And so at auction, they would sell these bonds and shift all those funds from reserve accounts to securities accounts. And they would have eliminated the conversion of the currency in the depletion of their reserves. Otherwise, if they didn't do this, they'd lose all their gold reserves. Everyone would cash in the money and the gold would be gone. And then they'd default on their entire system, which was based on conversion. And so it served that purpose. Okay, well, that's gone. So now it's no longer applicable. It's an anachronism, let's say. And they're just doing the same thing anyway. And what these bonds do is support rates, but the government realized that, look, this is just rate support. We no longer need to shift reserves so they don't take our gold. They probably wouldn't bother doing it. But it's just the momentum left over from fixed exchange rate policy, I think, that's keeping it doing it. And also, under that fixed exchange rate policy, you needed higher rates to tighten up, to keep people from cashing in the money, taking the gold, making loans, getting the money, taking the gold. And so higher rates was, in that sense, protecting your gold supply. And it was borne by the taxpayers. And today, since it's no longer applicable, nobody has the option to do that. Higher rates, you're just paying out more interest for no reason. And it's expansion. It's just what I call basic income for people who already have money. And so if you look at it the correct way, the way it actually works, I don't think you'd be doing this. When I talked to people at the U.S. Treasury, a couple of them had read my book. In fact, a friend of mine was there and asked if they had read my book. This was a few years ago. And they said, yeah, but don't tell anyone. So this is like senior officers at the U.S. Treasury. Yes, but don't tell anybody. Like it's Marx or something. Like they're communists because they read my book. So anyway, when you ask them why they're doing it, it's because, the rating agencies want us to have a 4-year maturity or something like that. And that's what we have to do. So they're complying with the rating agencies and increasing the maturity of the debt from 3.6 years to 3.8 or whatever. It's nonsense. In full knowledge, it was just a concession to rating agencies that really have no consequence at all.
So a lot of our system at the moment, one of the big reasons people support continued issuance of bonds is that our pension plans are linked to them, our private pension plans. So what alternative arrangements would you make for pensions?
When you say linked to them, what kind of link?
Well, as people come closer to pension age, they tend to move their kind of savings into government bonds because they consider that the safer bet.
Yeah. There'll still be private bonds and there'll still be banks that pay interest on savings accounts. When I first started, there were no long-term government bonds of any consequence. We use AT&T 7 1/8 bonds were the kind of the reference thing when you said, how's the bond market? Oh, the TEL 7 1/8 are at 7% or whatever. There were no government bonds. That's relatively new.
Okay. I was going to ask that because there's a Canadian strategist that we've had on the show, Kevin Muir, really nice guy. I don't know if you know him. Yeah. And he writes the Macro Tourist newsletter.
Yeah.
And he was saying that, obviously zero interest rate policy is, as you've said before, the way to do it would be you're not allowed to issue anything longer than a 3-month Treasury security because you've already got the legal structure in place for that kind of a change.
Right.
And so if you take away the yield curve as I guess a benchmark to as an indicator of market sentiment, a lot of strategists find that useful. And I think you've kind of answered that you just use I don't know, the next safest asset, but it's not risk free anymore, I guess.
You don't run a cottage industry shifting billions of pounds from pension funds to bond traders because a couple of traders find it useful. Excuse me. Okay, that's on one side of the scale. What's on the other side?
What I understand you're saying then is that we don't actually need any alternative arrangements for pensions. That is simply you just take out the bond market out of that equation and carry on as we are.
What's our equivalent of Social Security over there?
We would call it a state pension.
Yeah, why don't you just have that and not have any of this investment nonsense?
That would be my preference as well.
You know what the reason is? They talk about moral hazard. So if somebody knows when they reach the age 70, they're going to get 3,000 pounds a month from the state, then they're not going to work when they're age 20. Like, excuse me? That makes no sense at all. And that way you don't have any of this saving stuff. They all used to think you need savings to have money for investment, right? That's one of the deadly frauds. You don't. It's completely backwards. So without that, all these structures, institutional structure to encourage savings is inapplicable. It's just entirely inapplicable. It doesn't need to be there. It's just a waste of real resources. It's taking away from a real standard of living, the whole financial sector.
Yeah, I just think we're at a point now where a lot of people, and it's terrible that it's happened in Britain to the extent that it has. We're at this point where after the 80s, culturally we shifted to this area where it was, look, you deserve better. You deserve better than a state pension. Yeah. So a smart person would be doing this, that, and the other, and putting their money here and there, and all these financial products started to be for sale. Yeah. And now they're all people who are coming up on retirement. I mean, I personally have got a pension plan because I was a self-employed person for about 20 years now. I've been more than that, 25, 30 years I've been self-employed. So, it seemed to me, I should have some provision. It's barely, I'll probably get a carriage clock when I'm 90. But it's a worrying thing to, I think, a lot of people coming up on retirement to say, look, we're now just going to go, that stuff, it's not there anymore. You get what the state thinks you're entitled to.
Yeah, you can still have money put aside for later. That's fine. It's not going to earn very much interest unless you take a lot of risk. You might lose it. the stocks are going to be a lot different. You're going to have different kinds of companies. All these financial service companies aren't going to be there. You have basic industry type of companies, basic services type of companies. If you look at corporations, they're pass-throughs, right? If you tax a corporation, fine. The corporation is just a piece of paper. The tax gets paid for by whoever buys the products. So we got these pass-throughs there, and they have limited liability, which the state gives them, right, when you get your corporate charter. So the people running it are not responsible for what they do anymore. The liability is all just whatever happens to be the value of the corporation, not the personal net worth of the managers. And I submit that's a valuable thing. Otherwise, we'd still have all these partnerships like we used to have. Remember Lloyd's, every once in a while they'd have a problem and all these people living on estates would lose everything because somebody made a bad insurance bet. Well, limited liability, you don't have that anymore. And so the state's granting this limited liability. The question is, why? Well, why does the state do anything? Why do we have collective action for anything? Some instructions go along with this corporate limited liability that you have to comply with in order to get this privilege from the state. There's no reason not to do that. There's every reason to do that. I mean, no one can argue that that's taking away anybody's rights or anything else. You can go out and do whatever you want and just have personal liability. Or if you want limited liability of just your company where you don't have to worry about losing your house if your company goes broke. If you want us to give you that, well, then here's some instructions to go with it. Here's some rules to go with it. So you can set up any rules you want for corporate governance, corporate ownership, whatever. It's not like the private sector, the corporations are entitled to, because they're getting this gift from the state. It's not something they had without the state. Before the state, there was no such thing. If you made a business deal and it was wrong, the town would come out and do really bad things to you. The state is the one that's giving people limited liability. So, that's a whole area that's unexplored in terms of corporate responsibility and governance. Just want to throw that in.
Before we move out of the bonds area, last thing.
Yeah.
You hear this all the time from progressive commentators. The government shouldn't worry about increasing its borrowing right now because interest rates are so low.
Yeah.
As I understand it, that's not an MMT take. The ability to pay back the money the government have quote unquote borrowed doesn't rise and fall on them being able to borrow at low rates. Am I right?
Right. That would be what you call a violation of Lerner's law.
Okay.
Have a learner don't concede the principle. The debt to GDP ratio is going to get us because the growth rate is less than the interest rate. And then you argue, instead of saying, look, it doesn't matter. It's just the money supply, the net money supply. If it grows, it grows. If it doesn't, it doesn't. Instead, you say, well, no, you're wrong about the growth rate. If you measure it this way, the growth rate's actually higher than the interest rate. You're wrong about your conclusion. Well, you've just violated Lerner's law. You're out of paradigm. You're talking in the incorrect paradigm of the person, making the point. You just don't do that. So I try and not violate Lerner's law. Not that I might not slip in once in a while, but if I do, tell me, because I hopefully haven't done that.
So, but the answer to that particular talking point is, look, the reason the Bank of England or the government will be able to pay back anything that it's quote unquote borrowed is because it creates the money when it spends. It's not going to run.
Yeah, it just credits account. You can say, look, so when the Bank of England goes to change the number in your bank account to make a payment, what's going to happen? They're going to get an electric shock or something? They're not going to be able to change the number from a 10 to a 12 or whatever it's supposed to be.
You'll give them ideas. They'll probably rig that up if they hear this, Warren.
Yeah.
Well, the first thing I say to these people when they say, now we can borrow because interest rates are so low is, well, the government sets those interest rates, right? So why don't you just...
Well, the other thing they have backwards is we might want to raise interest rates to fight inflation. Well, once you point out raising rates makes it worse, why would you do that? You lower interest rates to fight inflation. If you agree that you have to raise rates to fight inflation, then their argument makes some sense, because you net spend all this money now, put it in reserve accounts or whatever, and then someday you want to raise rates. The way that you have to do it is to pay interest on all that money, and that will make inflation worse. Yes. And the new Keynesians say that. Well, we can't run up the debt now because if we have to raise rates, it's going to make inflation worse. And I say, I agree. But it already makes inflation worse for raising rates. We already have 100% debt to GDP, which is more than enough. You've already got that interest rate thing backwards. You raise rates if you want to increase inflation. And then I gave you the whole academic thing about that is the inflation rate. If you want to lower inflation, you lower rates. And that is hard for them to even a lot of MMT proponents, leading MMT proponents, kind of choke on it. And Turkey just took a huge step, lowering rates dramatically, and inflation came down. I don't know what the mainstream explanation is going to be, but Erdogan there has finance minister who's been in touch with Stephanie and some of the other proponents for a long time. He's said, the high rates are causing inflation. We have to lower rates. Got in a big fight, fired some central bankers, brought rates down, and the inflation rates come down. I know it's just coincidental at this point. It sure didn't go the other way. Let's put it that way. They didn't lower rates and inflation up.
Right.
So I'm not going to try and argue causation in there, but it sure has the appearance of it. and there are other places too that have brought down rates. My example of the carpenter with a piece of wood, right? No matter how much I cut off, it's still too short. Or the hairdresser, cutting hair. No matter how much I cut off, it's still too short. No matter how much I lower rates, the inflation keeps going down. So let's go to negative rates. You're going the wrong way. Get over it.
Yeah, it really makes you wonder when the penny's going to drop, no pun intended.
Yeah.
So another problem that we encounter when we're talking MMT to people is the idea of commercial bank credit. Recently, one of our patrons, Rory O'Brien, asked us, he said, I've arrived at MMT via Positive Money, and I'm trying to reconcile what role commercial banks play in MMT. We did an episode with Sam Levy on endogenous money.
Yeah.
So he's listened to that and he's found it interesting, but he couldn't quite work out exactly where the credit that commercial banks create ends up. What he said was, especially when related back to the MMT idea that the national debt is the private surplus, does that show up in the accounts the banks have at the central bank, or is it separate? But the last part of the question, the reason I'm asking you, Warren, is he goes, how would commercial banks work in Warren Mosler's Pompeii, for example? And at the time, I was like, oh, well, if only Warren Mosler was here. And here you are.
Okay, so commercial banks are agents of the state, right? Federal Reserve Act establishes the commercial banks. They're members of the Federal Reserve Bank. They can change their management. They insure their deposits, everything else. So they're a state agency, let's call it, and their job is to lend based on price risk, price loans based on credit risk. And they have shareholders and they compete with each other. So if they don't charge enough interest, they have no return on equity. They won't get any investors. If they charge too much interest, they won't get any business. The other banks will get all the business. And so through that private ownership or competition, the loan officer, who's an agent of the state, is pricing risk based on risk of loss, based on return of equity for his shareholders. Okay, but he has fairly narrow scope. It's kind of like the soldier on the front lines. In the U.S. Army, they get to aim their rifles, pick out their targets. In other armies, they don't. They're told where to point their rifles, how often to shoot. But, so it depends on how much leeway you give them, but they're still agents of the state, even though they have leeway. So commercial loan officers have leeway in terms of pricing risk, deciding some of it. Now, the state sets limits. The state might set limits because deposits are insured by the state. If you want to keep your insured deposits and you want to keep your status as a Fed member bank, you have to follow the rules. And so, yes, you can loan on property, but you can't loan on more than 90% of value or 80% of value. You can loan against this collateral, but not that collateral. If the income to the ratio has to be this. And they send in regulators and examiners all the time to make sure that the asset quality of the bank is complying with the regulation. So in that sense, the government itself, the regulators, are setting policy as determined by Congress as to the scope of state lending through its agents, the banking system. So they're government loans. They're all government loans. Okay. And they just have a system for determining it based on return on equity for shareholders. So it's kind of a hybrid system, public-private partnership. Now, a public bank is the exact same thing, except they're not competing with anybody. It doesn't really matter if they make more loans or fewer loans. They don't have a profit statement like that. So how do they decide whether or not somebody gets a loan? So if you want to borrow money from the Fed now is looking at different corporations. How do they decide who gets a loan? They don't just go by creditworthiness. Oh, Apple's the most creditworthy. You can have money at 1%, but digital equipment or something, have money at 3%. They're not doing that, right? They're doing it on something else. They're doing it on some form of political purpose to keep the economy going or something. They're in here now buying corporate bonds with the idea of making sure corporations can get money for something other than, pricing risk, to make a profit for shareholders. That's got nothing to do with it. So public banks become, and by definition or by default, are politicized. And the risk is it comes down to if you're serving the interests of the Republican Party and we have a Republican president, you're more likely to get a loan. you're serving the interests of the Democratic Party, if you're a Democrat, you're more likely to get along. It's pretty hard to get away from that. I'm not saying you can't, but that's what public banks tend to do. In Europe, the banks used to all be public banks. So French banks like Paribas was a public bank. And back in the 80s and 90s, every few years, they'd take some staggering $5 billion, it might have been 25 billion franc loss or something like that. And next thing you know, it became part of the government budget deficit. And life goes on as if it never happened. And it added probably to the inflation rate over there a little bit. Not at the time that they took the loss, but when they were making the loan, it was part of this total spending. And that would just happen repeatedly. And there was never a banking crisis where the exchange rate was floating. The franc was whatever it was at. And maybe it went up or down a little bit over time because of this banking policy. And it was entirely politicized. People who were insiders or favorables, would get loans, and businesses weren't necessarily state-owned, but they quasi-state-owned. They all went to the same school, right? All the officials came from the same place, and they all supported the economy that way. And there wasn't a revolution. I guess the students would take to the streets once in a while. The society seemed to function and went on. Now, I'm not supporting that kind of system, but there are issues with both public and private banks, is what I want to say. They're both very dangerous animals. And they're both there to offset decisions to not spend income. You can't have any net savings in the economy or you can't have any gross savings. You can't have any savings. Any one agent can't have a savings unless some other agent is spending more than his income. Any one person can't spend less than his income unless another's spending more than his income. Otherwise, you won't have the income. And so, the total savings in the economy, not even net gross savings, is equal to the total deficit spending, private and public put together. And the interesting thing is private sector deficit spending, private sector borrowing is always highly pro-cyclical. As things are good, it accelerates. When things go bad, it collapses. And the only entity that can act counter-cyclically is the state. So you'll see the state expanding its deficit spending and slowdowns and automatically sort of contracting them in expansions. It's just the nature of the system, how it's set up. And that's the big takeaway from Minsky, by the way, that the private sector is pro-cyclical. And he goes into the whole thing. But what he's really showing is how on the way up, it expands, and on the way down, it collapses. And the state's got to go the other way. That's been in the literature for 400 years.
That whole concept of stability being destabilized.
Yeah, in 1598, they published a thing, and it's called, it's a whole thing about unspending. I'll think.
But okay, while you've got that percolated, so this final part of the question about how would commercial banks work in Warren Mosler's Pompeii?
Oh yeah,
I guess they would be writing IOUs.
Okay, so the state would give some charters out to have commercial banks, enough to be competitive, maybe 4 or 5, and we had 20,000 coins in the street. Remember that in Pompeii? Okay, so you could deposit those at the bank. And the state would guarantee that if you wanted to take your money out, you get it out. So now the banks can make loans, and the state will give the banks whatever coins they need to make loans. They don't need those 20,000, but they can take deposits, those 20,000 coins, and they can make loans. So if a business comes into a bank and wants to borrow 1,000 coins, the bank can lend it to them, and they can get the coins from the state. The state's guaranteeing liquidity, and they make the loan, and that's it. And then somebody else has the coins and they get spent. So it's exactly the same as if you borrowed from the state, who has the coin box, manufactures them, except that the state's using these banks as their agents on a for-profit basis, competing with each other to price loans based on perception of risk. And then the state would regulate and supervise them to make sure they're not making loans they weren't allowed to make because they're lending out the state's coins. They don't want them given to just anybody. They have to make sure they're properly secured by real estate or by income or whatever else. Serves public purpose. And they'd have to make their rules based on that. So it's pretty simple.
Would it be a fair analogy to say the 20,000 coins, they now become part of the reserve system, and now the so-called commercial banks are now running a system of IOUs, and if somebody wants to actually turn it back into state money, like we go to an ATM, like all the credit that we're looking at when we see our bank balance, that's commercial bank credit denominated in pounds.
Yeah.
If we want to see it for real, quote unquote, for real, we take it out.
They already had that. They already had that in Pompeii.
Got it, right.
They had businesses that would act like banks as a depository, and you just have drafts against your account, and those would trade. And so these would just be state insured, or city insured.
Yeah.
And I don't know that they did it. We're insured or not. I mean, I don't want the student of that. But once you set up your agents who can insure drafts, which are convertible into coins guaranteed by the state, then it's more convenient to use the draft than to use the coins. But they could still use the coins. There's no reason that they couldn't if they wanted to. But they already went to drafts.
Okay. Yeah. Yeah, I think the crucial thing to think about when when you say and we say, but banks are government agents, is you've really got to get it into your head that the government is standing behind the bank, saying, whatever happens here, we have the spreadsheet. Your money is safe.
Yeah. Well, they are the government. They are the government. They are public banks already, in everything except pricing risk and rewarding shareholders. That's just their incentive system for efficiency. Now, in Russia, when they collapsed in 1998, when you talk about drafts and papers, the corporations would still trade each other's debt, buy something from somebody, and then you'd owe them for it. Well, that would be a receivable and payable. And they called them arrears. So they traded in arrears, which came out of until the central bank opened up again and they started using rubles again. So rubles became arrears. I just think that's a wonderful term that I find just hits the nail right on the head.
So to bring it to the here and now, in this moment, coronavirus, lockdown, lost output, massive job losses.
Yeah.
How can the MMT lens help us figure out a way forward?
Okay, number one, we have to recognize we have a massive supply shock. I don't know what the unemployment rate is. The U.S. now is showing 20 million people on continuing claims.
Yeah.
The total number of jobs is down maybe 20 million more. Maybe it's more because of the people who weren't officially working, the informal economy. It's probably 20% of the workforce. The supply is not there anymore. So the question is, how does this supply shock affect things? If you just throw out a bunch of demand, give everybody unemployment compensation so everybody has the same money, but the total output is 25% less, is that what happened in Weimar? Is that what happened in Zimbabwe, Venezuela? Are we facing a excess demand versus supply? And it doesn't appear so. It appears that supply, certainly of the necessary things, is adequate. And we're losing we're losing supply in things that are non-essentials, like government services or education. Things that the market's not going to like. People want to send their children to school and the schools are closed, so the cost of an education double. No. You just don't get it, right? And so it's qualitatively different from what's happened in those other economies, but at the macro level, it's large enough to keep me worried. Because, so how much demand are we going to throw at this supply shock that turned into a demand shock? The reason you don't have enough demand that people lost income is because they lost their jobs and they lost their paycheck. So if you replace all their paychecks and their jobs with unemployment, and they're not all spending it on things that don't exist because they're not working, we're okay. Okay. And it's not going to be some kind of inflation. Again, the numbers are huge. So I look at numbers from like the Fed Atlanta, they just show GDP down almost 50% for the second quarter. So it's not really a forecast, it's a nowcast, but let's say it's a forecast. That would mean US GDP is down from 6 trillion to 3 trillion in the second quarter.
Jesus.
Well, if that's the case and the government's throwing $1 trillion at it, $1.5 trillion, it's not enough. But then you go to the Philadelphia Fed or the New York Fed, and they're showing down maybe 20 or 25%. So that's $1.5 trillion that we're going to lose. Now the $1.5 trillion the government's throwing at is kind of okay, but it's at least roughly in balance. Then I look at the retail sales number, and that's down maybe 15%. Now all of a sudden, that $1.5 trillion the government's throwing at it is too much. We could get an inflationary shock on the demand side. Well, all you have is your forecast for where we actually are. And I just gave you 3 numbers that are showing very different things. And it's not because somebody's lying or anything else. It's like, how's anybody supposed to know? And so it looks like the fiscal adjustment's sort of right, maybe. I can't say it's wrong. I can't say it's inflationary. I can't say it's deflationary right now. It's probably as good a guess as any, maybe. Now, I'm not the Fed spending 200 PhDs looking this stuff up. So maybe defer to them to see what they think. But you look at Europe, their fiscal adjustment's not nearly as large as the US. Well, is their drop in GDP going to be a lot less? I don't think so. It might be more, right? I haven't done the numbers, but it looks to me like there's a big shortfall in Europe of fiscal adjustment. Will they then respond to that with the larger fiscal adjustment when they see things are worse or not? I don't know. They're still arguing over like which country is going to pay for another country's problems. Now, to me, the answer to that is you give the euro to all the member nations on a per capita basis. That way it's equitable. So Germany gets the same amount per capita as Italy or Greece. So you can't say one country's paying for another because they're all getting the same thing. They're all getting their own obligation back, and you have the ECB do it. And the ECB either has negative net worth, which is fine, it doesn't make a difference, or if you want to do something for window dressing, let them hold tax credits from each of the member nations or something. Not necessarily let them do that as assets of their balance sheet. Okay. It doesn't matter what the balance sheet looks like, but if it's important politically or constitutionally to do something to the balance sheet, you can do something like that. But so large, if the ECB made a distribution of 25% of GDP to all the member nations on a per capita basis, they don't have to spend it. Germany can take their money and pay their debt down, GDP down if they don't want to spend it. Italy can spend it if they want. Greece can spend it if they want. Whatever. Maybe that's politically equitable and it can happen. But I don't even see them beginning the discussion. And so they're talking about borrowing bonds and who's going to guarantee them, which taxpayers ultimately pay for them. And they're talking about reasonably large numbers, but it hasn't been done in large numbers. They're acting as if the QE is fiscal adjustment when it's not. My biggest concern is Europe right now. They have the operational ability to fix it and to sustain things, but they're dragging their feet on doing it.
I just wanted to bring attention because you put in a proposal pretty early on during the crisis. Yeah. I just pretty much loved everything that was in it. But the one thing I did notice, for example, is that you didn't put so much emphasis on a what some might call a UBI, but it's not really a UBI. It's like emergency cash relief. Instead of that, you put emphasis on increasing the unemployment compensation and social security, state pension. Could you explain?
Yeah. So how do you replace what is lost? No more, no less, let's say. If you want to try and match things and not create an inflationary situation. Well, if you do unemployment compensation, you're only giving it to people who lost their jobs. If a lot of them lost their job, you pay out more. If a few did, you pay out less. So it at least gives you a semblance of matching, filling in this hole. And you need to know how deep the hole is or how deep it isn't. So that's kind of an automatic way to get to the right size. I also had in there offering a job to anybody willing and able to work.
Mm-hmm,
which is the other thing that fills in the hole. It's actually a deflationary, or it has a lower inflationary consequence than using unemployment. So again, with inflation being a risk here, you want to minimize your inflation risk. So that switches the unemployment pool to an employed buffer stock, which has a far lower inflation risk than unemployment.
Just for anybody new to MMT, why that is?
Oh, well, because employers don't like to hire people who aren't working.
Sure. So
if suddenly they have a burst of demand and they have to build more television sets or provide more services for repairing air conditioners or whatever, then they want to hire people already working. And so the 10% or 20% unemployed don't count. You have a labor shortage and they start driving wages while unemployment stays high. So you don't get a transition from unemployment to private sector employment when you have unemployment. You get a much better, a much smoother transition, a much more liquid transition when all those people are working, because at least they're going to work every day. They're clean. They don't get into fights. They have a supervisor that can recommend them. It's a huge difference. But once people are already working with an employment record, it's not so much about what they're doing, but that they're employable, that the private sector will hire them, train them, get going what they want. It's like if you have a buffer stock of butter and the price of butter starts going up, well, you want to make sure you kept your butter cold so that you can sell it out. If you didn't and it's gone rancid, you can't sell it. And so the price keeps going up.
So your proposal does include a job guarantee. It was like pretty much immediately job guarantee fund, $15 per hour jobs. And you very cleverly, I thought, you were using non-profit organizations to deliver this with speed.
Yeah.
Right. One of the arguments was about the job guarantee being used as a means of relief was obviously the speed at which it could be used.
Yeah.
I think you went around that quite brilliantly, but also others would have said, well, what the least we need right now is people to work. Yeah. What would you say to them?
Yeah, the problem is it's not safe to go to work.
Mm-hmm.
And so that's why we have these other things in there, the unemployment compensation. So because it's not safe to go to work, the 20 or 30 million Americans who have lost their jobs will get unemployment compensation, or the Europeans who have lost their jobs will get unemployment compensation. So that way your income at the macro level is no worse than what it was before. So yes, you're not going to get a lot of people going to work because it isn't safe. They might not want to work for the American Red Cross soliciting money or for some European nonprofit doing whatever they're doing. But they weren't working for them before. It's not like you have to replace people who used to be working who aren't. They were doing volunteer work before. There's no lost income associated with it. It's just a way to provide a transition from these 20 or 30 million people who are unemployed. And once it is safe to go to work, to get back. If it isn't safe, they're not going back, no matter what, no matter how much money you throw at them. They're not going to go until it's safe. Or they'll work from home, and people will come up with ways to do that, of course. But it's not a complete substitute.
I guess it's fair to say, there's probably not an insignificant amount of work that can be done at social distance and in isolation as well by charities.
Right.
A lot of what is needed now is organizing, moving things around.
Yeah.
PPE, food, in a safe way.
Yeah.
And I imagine your thinking was, well, the charities are already there at the coalface, knowing the sores of the community already. So let's fund them in the first instance rather than having to set up a whole department of figuring out what to do next. It makes total sense to me.
Yes, that's exactly what I was thinking.
You said a great thing, Warren, and I agreed with it.
Yeah. Excellent.
Great. I'm just going to pass that off as my own thought.
Yes.
In your plan, in your proposals, you've got eliminate the tariffs.
I was going to say that.
Yeah.
It's never not a bad time to eliminate the tariffs, right?
Well, look, if you look at the global economy, it was already in collapse before this thing hit because of the tariffs. So now if you do all this stuff because of the COVID and you still have the tariffs in place, this is nuts. And they're talking about here doubling down on the tariffs. It's like just madness, right? Killing the goose that's laying the golden egg. Just stop doing this. We don't need to do that right now.
Just run through it one more time for the new people. Why are tariffs like hitting yourself in the head with a frying pan?
I can't just say chapter 5.
Okay, then.
So, well, I like it to say, it's like we come down on Canada because they're not charging us enough for lumber. And China's not charging us enough for everything we sell at Walmart. And so they're bad people because they're not, you go shopping. How many times do you get mad at the store because they're not charging you enough? How can that be your problem? And the answer is because it's a productivity increase. When you have productivity increases, whether it's going from cutting the lawn with scissors to lawnmowers, you get people who are now freed up to do other things. And you just have to make sure that there's enough aggregate demand in real time to keep absorbing everybody into bigger and better things. And that's progress. And that's why we have such a high standard of living. And this is just going the other way. It's trying to eliminate and reverse this huge productivity increase that we've had through global trade. This is for the United States because we're running a trade deficit. Now, China's had a depressant on productivity because they're running this surplus. Well, that's not our problem. If that's what the whole point is, to make sure everybody in China gets a raise to raise their real standard of living at the expense of the United States, okay, fine. But that doesn't sound like an America First policy to me. But that's what it's turned into, right? So the whole thing is just a huge innocent fraud.
Chapter 5, like we said.
Chapter 5, yeah.
I was going to say, I do see the logic behind, decreasing our own costs at the time of a crisis. I'm just wondering whether sometimes having tariffs with countries that have, for example, what we consider to be unethical production processes.
Yeah, and that's absolutely the case. From that perspective, I'm totally in favor of targeting imports that are created in ways that we don't approve of. So we shouldn't be importing elephant tusks and things like that. We shouldn't be importing things made by child labor, and we shouldn't be importing things made by coal-producing plants and that type of thing. Okay, yes, that reduces our material standard of living. It reduces our material productivity, but I think it enhances our quality of life overall because, you don't live by bread alone, right? And so let's look at now. We've had a 25% drop in emissions. So what do we want to do? Just crank the economy back up and start burning coal again, and then so we can get the prosperity going? Like, no. Okay, there's hardly any effort that's been made to let's grow in some different area. We don't have to grow in that area. We don't have to start using more energy. There's plenty of other areas to grow that don't require more energy. Does anybody feel like they've been deprived by this 25% drop in air pollution or the 25% increase in air quality, whatever it is? Is there anybody out there feeling, oh, this is terrible. I wish I could do X, but I can't because it would pollute the air? No. Okay. It was all waste. It was all frivolous. It was all conservation, let's call it. I put out not too long ago that we could reduce our emissions 50% just on conservation. That's the biggest gain. And everybody said, no, you can't do that. Not practical. Well, here we just did that in some areas for sure. It was fairly painless, from that point of view, right? And it showed that non-essentials, which is all we've given up. We haven't given up any essentials. By giving up non-essentials, we've improved air quality by 50%. Doesn't that tell us something? Now, is that going to happen? Are we going to move in that direction? I don't know. Have you heard anything out of the green movement along those lines? I haven't seen it.
No, what we're hearing from the green movement, it's not really a homogenous thing anyway.
Yeah.
But what we're hearing in sort of this idea that it has to be painful.
I think it was Extinction Rebellion, wasn't it, Christian, that recently released?
Oh, God, yeah.
I don't know as well if
yeah.
Extinction Rebellion is a kind of a homogeneous group, but there was an article where they said we need to, we're basically going to have to tax everybody to fund this Green New Deal. Let's just accept that.
They didn't say we should act now to make sure we don't increase. We stay at no worse than current levels, which is down 25% or 50% improvement, however you want to look at it. There's nobody out there saying, okay, look, we need to not do anything that increases that back to where it was. We don't want to increase petrol consumption, right? Back to where it was. We want to leave it down. People aren't driving, fine. We want them to stay home. Okay. No, there isn't anybody saying that, is there?
I wouldn't like to speak for an entire movement, but I haven't seen it, and I would chime in with Patricia and just to say, obviously Extinction Rebellion and associated people, they've moved mountains to get the agenda on the front pages and really transform the conversation. But then, and this is why we love MMT, they're falling at the last hurdle.
Yeah.
At the point where we could now be going, look, see, it's possible. We're hearing or seeing statements about, look, we've got to get real. This whole thing's going to cost us, and we've got to raise taxes because it's cost us.
Yeah.
And it's like, how's it cost us? And so, what's that? Obviously, that's going to increase unemployment. I can't see any other way. It's going to lower the standard of living, and it's going to increase unemployment.
It's going to lose the support of a lot of people who already feel like they're in trouble.
Yeah.
So then it's very hard to talk to them and go, no, it's actually not like that. In fact, we really need to lower taxes and increase spending. And then when they hear low taxes, they think you're a libertarian or something. And
are there any other MMT proponents saying what I'm saying about let's not increase our emissions?
I'd imagine, say, Stephen Hale.
I see him on Facebook. I haven't seen it. I haven't seen anything on Twitter.
Maybe it's just one of those, you got to take it for granted that, that maybe nobody said it out loud because it's just obvious, like this is better for the environment, that we're not, driving and flying everywhere we go.
And it's giving up non-essentials. This stuff is not essential. Which is more essential? Non-essentials or the environment? Which one's more essential? The environment or non-essentials? It's like a stupid question, right? Why am I the only one asking that question? It's been like that for 30 years, These questions come up, and it's like, it seems like I'm the only one even asking. Same thing, 30 years ago with the whole monetary thing, right? So, okay, we got the monetary thing, but what's the point of it all? Here we go. Well, there, it's right in our face. Non-essentials just reduce emissions. Okay. Let's get the non-essentials back going again. It's like, what? You just said they're not essential. Why are you proposing cranking them up?
The narrative that's coming from all quarters here is that we have to choose between health or jobs, right?
Why don't we ban the non-essentials?
Yeah.
Isn't that kind of logically the thing you would do? If it's not essential, you ban it. Unless you can do it without increasing emissions, you can't do it because it's non-essential. Not only that, we've already stopped doing it. It's not like we have to drop something we aren't already doing.
Yeah, no, it's a very good point. It's a very good point. We should be hammering on that more for sure.
I assure you it's going to die with this interview.
Did you think?
Hopefully not.
No, I've been there before. It happens all the time. 5 years, some grad student will pick it up somewhere and look at the interview and maybe they'll get going on it or something.
Really optimistic of you to think that we're going to be here in 5 years' time. So.
Yeah, sure do.
It's good to leave it on a positive note.
Yeah.
But
yeah, so obviously, Warren, MMT has come a long way since you started this a long time ago. And I think one of the elements that we were discussing with Christian yesterday was that part of that success is owed to the fact that Bill Mitchell, for example, released a blog and involved the grassroots in this conversation. And we were discussing about what the pros and the cons of that approach were. And the pros, I guess, we all can all agree that is the fact that it disseminated information fairly quickly. But I guess the con might be that then the founders of MMT then lose some power over the information being released, you know, and the information is disseminated, and obviously you sometimes in ways that are not ideal. And I was just wondering what your views about MMT since its inception to now has maybe parts of its message has been lost in translation as it's become more popular.
Yeah, well, you can say the same thing about Marx and Keynes and that type of thing, right? Mm-hmm. But it just goes with the territory. That's how things work. I've documented everything I've said. This is being documented, what we're saying here now. So it's there for scholars or interested people at some point to get back to. And this core understanding, it will always be there, whether they agree with it or not, or whether they want to change it or use it for their own purposes. And it's always there to come back to. And things will get away from it, but you'll find university professors, instead of looking at the economists they're looking at now, they'll be looking at this stuff. Guys like Scott Fullwiler or Fadul Kaboub, they'll be there. Somebody asks them a hard question, they'll go back and look at something I wrote or something Randy wrote or something Bill wrote. And they're going to have grad students, and their research projects are going to involve reading us the same way economic student today would read Keynes or Milton Friedman. It's going to be, in this case, part of the core literature of economics, because it's been recognized that what I have in the white paper has happened. Okay, that we've changed the sequence around. The state spends first to provide the funds to pay taxes and buy bonds. That will always be something to come back to, and can't get away from that. They're not going to go back and they're not going to turn it into, the government is running out of money. Okay, we've gotten rid of those types of things. And at some point, they'll come, none of them are talking about it now, but they'll get around to the idea that they got the interest rate thing. And they'll get around to the idea that the price level is a function of prices paid by government and not expectations or anything else. They'll come back and take a serious look at it, the next generation of scholars. And I've got some guy who's written something called the Blue Paper or something. It's really very good. Now, about halfway through, he gets off on a tangent on savings, but he went back to the core, went back to my stuff. I wrote Bill's white paper. He's got it all in there. So I can see they're all going back to that for their starting point, and then they might get to somewhere else, but the others will correct them or be part of the debate. So I'm pretty hopeful that it's up and running. It's on the way. It's going to develop. There are going to be a lot of tangents, but there's going to be a core understanding that is in the middle of it all, that in the next generation and the one after is going to not lose that core understanding, for one reason, because it's so easy. There's nothing difficult. And it's entirely logically consistent. And if there was any problem with it, it would have come out by now, after 30 years of discussing this with senior economists everywhere. If there was any problem, I would have heard it. Clearly, there's no issues with it.
I think the challenge is to keep the MMT message, the paradigm clear and accurate. Do you think there's any points, or we're talking about the grassroots now, do you think there's anything we need to focus on just to sort of like sharpen up the focus on any aspects of MMT?
Yeah.
That's how MMT is getting passed around now, and I think that's what's putting a flame under the policymakers, is people know stuff now.
Yeah.
Whereas before they were just like, okay, we're running out of money. I guess we've got to have a rotten life now. Thanks, everybody. Let's all die.
Yeah, that's basically it.
Thanks to you, people know stuff now.
Yeah.
Just to make sure that, everybody's still singing from the same hymn sheet. Do you think there are any points that are getting garbled anywhere?
Let me give you an example. The job guarantee. It's like, now we can have all these new green jobs under the job guarantee. And I'm like, wrong answer. The job guarantee is to promote the transition from unemployment to private sector employment. If you want to hire people, green jobs, just go hire them at normal public pay scale and everything else. Don't try to get them at half price through a job guarantee scheme and not hire them and save your budget or something like that, because you're undermining the whole public pay compensation and the whole thing. And it's, and Paul Davidson, he's post-Keynesian way back when I first started talking about full employment price stability. He said, well, yeah, why don't we just, provision a whole government under job guarantee, because all the other people that are more highly paid and everything go to the private sector. The economy will be a lot better. It's like, okay, that's exactly what would happen. And these people who are talking about provisioning the green economy with people in the job guarantee are talking about $15 an hour people having all the government jobs and keep tight enough fiscal policy so that you have that and all the higher paid people will be in the private sector. I don't think that's their vision. Okay, but that's what they're saying, whether it's their vision or not. So I don't think that's their vision at all. I think their vision is to have a strong, vibrant, whatever you want to call it, informed, articulate public sector. So we have good public services, well educated and everything else. Well, you don't do that by provisioning it through a job guarantee. You go out and hire those people through the public sector. And you'll use a job guarantee to A, give people a safety net, but B, and as a buffer against inflation, but it's a buffer because it enables these people to transition back to the private sector. So I haven't gotten very far on it. I'll turn on a Bloomberg interview with some MMT proponent. They'll say, well, what are all these people going to do in a job guarantee? And they'll say, oh, there's lots of useful things to do. And I'm like, no, wrong answer. They'll transition to the private sector. The useful things to do, we'll just hire people to do that. But, I can't stop it. Doing it the way they've done has caused the job guarantee to get international, intergalactic recognition, people going back and studying it, brought MMT up a level, the news cycles and the awareness and everything else. And so in that sense, it's served everybody well to have them do that, but it's not the way I would have done it. And it's not the way I've been asking to do it. And whether better to have done it the way I thought, I don't know, maybe not. Maybe from a marketing point of view, they've got it right and I've got it wrong. So here I am, not violating Lerner's law, being intellectually honest about the whole thing. That might not be the ideal way to market it, right? Maybe they've got it right. So I'm not critical. I'm just saying what I say, saying what I know, telling them how I see it and how the logic works and what I think is the most marketable, which is always just straight on truth, which may not be the case.
Well, as we've seen from election to election in the last few years, it might not be the best policy. I think it comes down to nuance, Warren. Yeah, I love that way of framing it and just go, what are they going to be doing in the job guarantee? Transitioning.
Yeah.
But I think there's a certain type of person who wants something that feels like more of a substantial answer to it.
Yeah.
So I think there's a way to say it where you go, again, I think this is like the way John T. Harvey would say it is, well, there are things out there that need doing that it's not profitable for the private sector to instigate. We know this.
Yeah.
So, there is a pool of useful things.
Just hire those people to do what you want done. You don't use a job guarantee for them.
Yeah.
The idea, though, is that there's certain logic to this whole job guarantee thing, and it's been popularized on a different logic, but it's been successfully popularized. But I don't think the people who popularized on that logic want to see that their version actually taken to its logical conclusion, which is, you got all these people in this job guarantee doing things rather than properly paid public employees. I don't think that's their logical conclusion that they want to see.
Got it.
And they'll say, well, you don't do that. You have it in it specifically that don't hire anybody you would have hired. Well, how are you supposed to know that? You got all these $15 an hour people looking to do stuff. You have them do it. And that person could have been hired directly. As a practical matter, doesn't work that way. Anyway, I like what they're doing. I certainly support it. And, I seriously commend them on their success and how far they've gone.
Did you have any thoughts on the TUC job guarantee?
What is that?
Trade Union Congress job guarantee proposal?
I haven't seen it. What was it?
It would be better if you called it a training scheme. Basically, it only gets offered to people who've been unemployed for 3 months or 6 mons, depending on their age. So it's targeted at the young who are obviously going to be very vulnerable to being unemployed and then also becoming long-term unemployed.
Yeah.
But it is centrally funded and locally administered.
Yeah, I'm certainly in favor of it. You don't let the perfect be the enemy of the good, right? So I would just open it up to anybody. Again, for me, let the nonprofits hire people. Because the private sector doesn't need training if the private sector is properly funded in the sense that there's enough aggregate demand. If there's enough aggregate demand, part of the price they charge will include training for their employees. All the banks have huge training programs for their employees because they're adequately funded, of course. And so do all the large tech companies. They all train their people. all the large businesses that are adequately funded train their own people. So you keep enough aggregate demand out there, people will get directly or indirectly all the training they need from the private sector, but hire people for the public sector to do the jobs you think serve public purposes, public sector employment. Sure, absolutely.
One last question, I guess.
Yeah.
If there's one thing a listener should take away from what we said in this interview or MMT in general, what would it be?
Takeaway from this particular interview?
Or MMT in general?
Let's see. I guess it comes down to what I call the white paper. The main takeaway is that what MMT offers to the conversation is that they've got two important things backwards. Number one, the order of spending. Every member of parliament thinks they have to raise money through taxes to be able to spend. If you can't get the money, you can't spend it. You can't get it in taxes, you have to borrow it, or you can't spend it. And then you leave the debt to your grandchildren. Okay. The truth is the opposite of that private sector needs the government's money to meet its tax liabilities. So the actual flow is that the government has to spend first before the pounds, the dollars exist so that taxes can then be paid, so that bonds can then be paid. So they've got it all backwards. So once you understand the correct sequence, spending comes first and then the funds are there for taxes to be paid. The idea of where you get the money is no longer applicable. You start asking different questions. Why should we spend the money? Not where is it going to come from? Because it's going to have other consequences. Okay. And the idea of what if nobody buys the bonds, funding ourselves? Well, you're only selling bonds to people after you've already spent the money to give them an investment. Doesn't matter either whether they buy the bonds or not. Okay. So that idea of sequence is the main MMT contribution that started over 30 years ago, that they've got the sequence backwards. The other thing is that they've got the interest rate thing backwards. Lower rates actually fight inflation, higher rates cause inflation. They've got that backwards. That's the other takeaway. So when you see the Bank of England lowering rates to help the economy, they got it backwards. You see them raising rates to fight inflation, they got it backwards. It works the other way. You'll be able to watch it backwards like I've done for 30 years, working in the wrong direction. They raise rates and inflation gets worse. So they say, we just didn't raise them enough. So they raise it some more and it gets worse. And you're back to the carpenter saying, no matter how much I cut off, it's still too short. And then until something else crashes the economy. Okay. And the other thing in the middle of all this is that less important as a takeaway from this, but critically important from any scholar is that because the money to pay taxes comes from the government is setting the terms of exchange. We need the government's money or we lose our house and car. If it doesn't spend, we can't pay our taxes. We're in default. We're in serious trouble. It sets terms of exchange. It tells us what it's going to pay us when it spends, and whether it knows it or not. And it doesn't know it. So the source of all pricing comes from prices paid by the government when it spends. The same way interest rates, the source is the government. They vote on it. Okay, they're doing the same thing when they're spending. So the source of the price level, the source of inflation is always prices paid by government when it's spent. If prices start going up in the economy and government doesn't pay the higher prices, the economy will collapse and prices will come down and the government will pay the prices it offered. Problem is that's a very bad way to run an economy, but it illustrates the point that that's the source of the price level. Prices go up and the government pays those higher prices. Now it's institutionalized them, and that's the source of inflation. So ultimately, overspending is not it. You'll see MMT proponents say, if the government spends too much, prices go up. It's not that it spends too much. It's that if the government pays the higher prices, then those prices go up and stay up. Okay, they're not there permanently until the government pays. Otherwise, they're just relative value.
So it's entertaining the inflation tendencies of the private sector, basically.
Yeah, the higher prices, right? It's institutional. And it does it through indexation. It sees the CPI go up, so it gives all government workers more money so that it can afford things that are now more expensive. Well, it's just redefined its currency downward. It's paying people more money for doing the same job. That money is now worth that much less. And the story of Pompeii points that out, where the price of that coin comes from. It's what the government tells you have to do to get it. First order is sequence, got the interesting backwards, and then people start worrying about inflation. Now, the takeaway there is that it's all about prices paid by government. The government tells us what we have to do to get its money, and that's the source of it. Now, the policy ramifications and everything else get complicated, but you have to understand the source to get the answer. Mainstream still believes that inflation expectations cause inflation. And if you ask them why our prices are the way they are now, where did the prices come from? They don't know. They just say, well, it's historic. Give us a historic price like today's prices. We will tell you what makes it go up or down from here. Give us the prices of 1900 and we'll tell you what made it go up or down from 1900. They'll use inflation expectations. And the reason is they've had other ways to judge it that they used to use, money supply and all that, but they all fell apart. So they have nothing left now except expectations, which is complete nonsense. Once you understand the money story, you realize it's just not a factor. Once you recognize that currency is a monopoly, which is the core understanding, currency is a monopoly, it's a public monopoly. From that core understanding, you understand the government spends first because it's the monopoly supply. And that the price level comes from the prices. Monopolists set price. That's why you don't like it. It's because there's no market to set price. So I don't know, that's not a real short takeaway, but you can condense that. I got faith in you.
It's a good one, though.
It's a great overview. Okay, so I'll just do the wrap up now then, and we'll say goodbye.
Thank you. Let me do the wrap up first. Thanks very much for having me on and giving me the opportunity. And you guys are the best. And anytime I'll be on. You just tell me when.
It's a pleasure, honestly.
Okay, thanks, Warren. It's great to talk to you, and look forward to talking to you next time.
Okay. Ciao.
Bye.
Cheers. That was the MMT Podcast with Patricia Pino and Christian Riley. Don't forget, you can support the show through Patreon, starting at $1 a month and get early access to all our episodes and patron-only episodes. You can do that by going to patreon.com/MMT Podcast. You can also find me on Twitter at MMT Podcast, and you can find Patricia on Twitter at Patricia N. Pino. And you can email us at mmtpodcast@outlook.com. Editing and post-production was by Damien Caldwell. Thanks for listening.